Fixed versus variable rate mortgages. Which one should you choose? Before we get into this video, my name's Cole Dowling and I work as a Canadian mortgage broker. I'm based out of British Columbia, Canada, and my hope with this channel is to inform you about everything there is to know about mortgages. I want to make sure that you make the best choice when you're choosing your mortgage. Please subscribe below to make sure you don't miss out on any of the upcoming videos and to stay up to date on everything there is to know about Canadian mortgages as well as investing in real estate. Let's dive into fixed rate mortgages. We'll talk about how rates are determined, we'll talk about the different term options that you have, and we'll also talk about how much is it going to cost me if I want to break my mortgage early or if I want to pay off that mortgage early. Okay, so let's talk about how rates are being set. Rates for fixed rate mortgages are determined by the bond market. Bond yields specifically are what determine fixed rates. So if we have a bond yield of say about 3%, you can expect fixed rates to be approximately 1 to 2% higher than that. So either 4 or 5%. The reason I give that example is because that's currently the environment we're in. We're looking at fixed rates between about 4 and 5%. The other thing that's important to note here is that as inflation goes up, we expect that fixed rates will also go up. And on the contrary, as inflation goes down, you can expect fixed rates to go down as well. Okay, so what are the term options? You can basically choose anything from a few months all the way up to 10 years. The most common choice is typically a 5-year fixed term, and this is where you're usually going to get the best rate. Is this the right choice for you? That's something we'll talk about at the end of the video, so stay tuned for more about that. The last thing we're going to talk about under fixed mortgages is the penalty to break that mortgage. What's the cost if I have to break that mortgage? If I'm breaking a fixed rate mortgage, there's 2 different penalties that you might need to consider. Either a 3-month interest penalty or an interest rate differential. 3 months interest is very self-explanatory. You can expect to pay the equivalent of 3 months of interest on your mortgage. Now with interest rate differential, it's very important to note that different mortgage lenders calculate this differently. Typically, the big banks in Canada have less favorable mortgage penalties, whereas monoline lenders, which are lenders that deal with strictly mortgages, for example, First National or MCAP, they're going to have more favorable penalties because of the fact that they calculate the penalty differently. Now we'll talk about variable rate mortgages. We're going to cover the same 3 topics we covered in fixed rate mortgages, but we're also going to talk about the 2 different types of variable rate mortgages. So how are rates determined for variable rate mortgages? It's pretty simple actually. The Bank of Canada sets their overnight rate, then the bank or the mortgage lender will set what they call their prime rate, and then you as a lender will get a discount typically off of the prime rate, and that will be your variable rate. Now, as you can imagine, as prime rate for the bank changes, you can expect your variable rate mortgage to change. So recently, we've been seeing the Bank of Canada cut their overnight rate, which has also led to the banks cutting their prime rate. Therefore, people are starting to get lower mortgage rates for variable rate mortgages. The other thing I want to talk about are term options. Variable rate mortgages have less term options compared to fixed rates. The most common terms are 3 or 5-year terms. And the reason for this is the next point. What's the cost of breaking a variable rate mortgage? It's quite simple. It's just 3 months interest. And 3 months interest is typically going to be less than interest rate differential, which is something that you may have to pay on a fixed rate mortgage. What else is really interesting to know about variable rate mortgages is you can often convert them from a variable rate to a fixed rate and not have to pay a penalty to make that conversion. Now, there's one more very important thing that we have to talk about when it comes to variable rate mortgages, and that's the type of variable rate mortgage. There's what we call a static payment or an adjustable payment. As you can imagine, a static payment means the payment amount does not adjust if the rate adjusts. Whereas with an adjustable rate mortgage, as the rate changes, you can expect the payment to change. Now, there's benefits to both, but there's also drawbacks to both. Back in 2021 or 2022, many people chose a variable rate mortgage, and a lot of these people chose a static payment. This meant that as interest rates increased, their payments did not increase, but what it meant is their loans were stretched further and further to where they were only making interest payments. So therefore, they weren't ever going to pay off their mortgage.
What are you talking about?
While this might be good for some people because of the fact that they couldn't afford to make higher payments, it did mean that they're now not paying down their mortgage, or they're now looking at paying off their mortgage in a much longer period of time. On the other side of things, from the adjustable mortgage side, these payments did automatically increase, and many people were left in a situation where they couldn't make those payments anymore. So they were forced to switch to a fixed rate, or they were left in a position where they had to sell their home. So both options can be good and can be bad. Typically an adjustable rate mortgage is more preferable because as interest rates change, you're still paying down the mortgage at the same rate and you're not worried about only making interest payments. But on the contrary, as those rates go higher, you're going to look at higher payments, and some people can't afford that. Now, the question really is which one's a better option if I'm choosing a variable rate mortgage. And again, we'll get into that at the end of the video, but the main thing to note here is that one of them, the payments adjust, the other one, the payments don't adjust. All right, let's circle back to the trigger rate. The trigger rate is used for static variable rate mortgages. If you hit what's called the trigger rate, you can expect your payments to adjust because you're now no longer making a large enough payment to pay down the interest accruing on that mortgage. Now, this is really important because many people hit their trigger rate when they took a mortgage back in 2021 or 2022 because of the rapid increase of mortgage rates. And what this meant is while they did think that they wouldn't have a payment adjustment, they did. And a lot of them, again, were left not being able to make those payments or they had to sell their home. All right, let's talk specifically about rates now. We'll look to the past, we'll talk about the present, and then we'll also talk about what's expected in the future. Let's first look at the past. So if we look far enough back and we compare fixed rates to variable rates do typically outperform fixed rates. This might surprise you, as if we now look to the current time, fixed rates have been outperforming variable rates for the last few years or so. We're looking at about a 1% spread between fixed rates compared to variable rates. On average, you can expect about a 4.5% fixed rate right now compared to a 5.5% variable rate. Let's look ahead to the future. It's projected that variable rates will probably drop another 0.5% by the end of this year, and will probably drop another further 1% by the end of 2025. This would put us in a category of about 4% for a variable rate. But what most people are wondering is what's going to happen to fixed rates. It's much harder to project what's going to happen to fixed rates. The projections I've seen is that fixed rates will probably remain around steady, which would mean we're going to get into an environment where fixed and variable rates are more or less the same. The last thing we need to talk about, and it's probably the most important thing, is how do you choose a mortgage that's right for you? The number one thing to consider when looking at your mortgage options is your risk tolerance. Now, when we compare variable to fixed, this is very important because of the fact that fixed rates don't change throughout the term. Variable rates can change throughout the term. If you're not comfortable with the fact that that rate might change, variable rate's probably not the best option for you. Regardless of what speculators are saying, regardless of where rates are going, you need that stability of that fixed payment. The other thing we need to look at are the different types of mortgages. Is this a discounted mortgage or is it what we call a fully featured mortgage? There's a few things we got to look at here. If it's not a fully featured mortgage and it's a discounted mortgage, there might be some things that could cause you to not be able to get out of that mortgage. For example, you got to look out for what's called a bona fide sales clause. This means you can't break the mortgage unless you sell your home. Now, that might sound pretty extreme, but you may have got a better rate for being in a mortgage like that. And if you weren't planning to sell your home, that might have made sense at the time. The other thing you may have to watch out for are higher penalties. Previously, I talked about interest rate differential and 3 months interest. In some cases, you can pay an even higher penalty than one of those two options. So that's something else to watch out for. The third thing we got to look at is timing the market. This is not something that you should try to do. Time in the market is always going to be better than timing the market. When the time's right for you, that's when you should enter the market. The last thing that's worth noting when it comes to choosing your mortgage is that you should understand the forecast, but you should rely on current information. Forecasting is great. It provides predictions and it allows us to speculate about what might happen, but current information is the only thing that we can rely on. And if you base your decisions on current information, it will make it a lot easier for you to come to terms with that choice. If you made it to the end of the video, thank you for watching. Choosing the right mortgage comes down to your risk tolerance as well as your financial goals. Stay informed, consider your options carefully, and choose the mortgage that's right for you. For more updates and insights, be sure to like and subscribe.